What's up, guys? Welcome back to the show. Bitcoin and markets. Today is Monday, so it is Fundamentals Report Day. That's my newsletter that goes out every Monday. You can go to bitcoinandmarkets.com to subscribe. I read through the Fundamentals Report every Monday on these live streams. It covers all parts of the ecosystem, the Bitcoin ecosystem, from headlines. That's the main part because it's a narrative-driven newsletter. Then price, mining, and usually layer 2 or lightning. We didn't have any big stories that I saw that I wanted to include this week, so that section is not in here, but we do go down and cover all the main parts of Bitcoin. I am writing also now for BM Pro, which is the Bitcoin Magazine Pro newsletter, and you guys can find that at bmpro.substack.com. Producing one, they said one meaty article a week, so that's what I'm doing for them. If you guys want to support my content and support Bitcoin Magazine, then you can go to bmpro.substack.com and at least sign up for the free one, and there is a paid tier. All right, what you're seeing here at bitcoinandmarkets.com, all my stuff comes out there except for that BM Pro. Let's jump into the Fundamentals Report number 258. Memeing Bitcoin on Twitter. He's been having some good images come out. You can see the Bitcoin B here. Obviously, this is AI produced, and he's had a lot of these recently, and it's, if you squint, you see that Bitcoin B, and it's pretty awesome. I don't know what kind of inputs he's using on this or, the prompts, but this is pretty spectacular. The stuff out of memeing Bitcoin on Twitter is really awesome. Okay, snapshot of Bitcoin, slow sell-off. We will look at the price chart here in a minute. Media sentiment is still positive. There's a few positive studies and reports out about Bitcoin in the media. I saw like big name investors are still coming on and talking about Bitcoin in a very positive way. I mean, there isn't really any negative coverage of Bitcoin, which is very, very surprising. Network traffic is elevated but declining. We'll cover that in the mining section. The mining industry is surging. There is 204 days until the halving. I think that's like April 14th or 11th or something like that it is estimated to take place. Price section. We did go down about $1,000 since the last issue here. Last week. Stand by. I want to make sure I'm going out on all the proper platforms here. Yeah, we're looking good. Okay. Down $1,000. That's 3.6% on the price. The price is kind of boring. I mean, we're right back smack dab at this 26,000 range that we have been at for a very, very long time, 3-4 weeks. And there's just no life in this price. But the market cap is still above the $500 billion mark at $514 billion. 37.93 Satoshis per dollar, and one Finny is $2.64. Mining sector, last week we had a huge adjustment upward of 5%, almost 5.5%. But the next estimated adjustment is negative 2%. And this happened on the last cycle, or what is that called? Epic, difficulty epic or era. We were estimated to be a negative adjustment. And then as that 2 weeks went on, more and more hash rate came on and pushed it all the way up to a 5% positive adjustment. So we'll see. Right now, it's estimated in 7 days to be a negative 2% adjustment, but the mining sector has just been surging. So that could definitely change. Mempool is coming down about 50 megabytes lower than last week. Last week was 225 megabytes, and now it's at 175. Fees also are coming down 85 cents, so that's roughly 23 sats per virtual byte to get in the next block, and a median fee to get, I think, within the next 6 blocks is 66 cents. Lightning capacity. This was very, very disappointing. Last week, both of these, the Bitcoin capacity on the Lightning Network and the channels, went up. I think they both went up by roughly 1%. Now, this week, the capacity dropped by almost 3%. 133 Bitcoins in a week came out of Lightning channels. And this is public, obviously. I use mempool.space for these metrics. but that's not a good thing. Okay, Lightning is not taking off, and also the number of channels dropped to 67,000 even, and that's over 1% drop on the channels for the Lightning Network. I hate beating up on Lightning, but it's not taking off the way we should expect. Okay, in case you missed it, member stuff that came out this week, 2 Protons. Those are smaller market pros that I used to write. It's a new format, but I put one out in predictions for 2024 and cycles. And then this last one was Dr. Copper has something to say, plus Ethereum and Bitcoin forecasting. Okay, safe community streams. I did only one podcast episode last week, but of course, all these live streams, you can find them back catalog on Rumble, on YouTube. Check them out. Make sure you're subscribed over there. If you're watching on Rumble or YouTube, like, comment, subscribe. I go back in later and look at all the comments, and I try to answer what I can. So check that out and make a comment down below. Okay, blog posts still have these demographic ones and the coming multipolar world up here. If you haven't yet read those, you can check those out. Okay, headlines. Willy Woo. This is the biggest thing for me, at least this week, was that Willy Woo came out and said that paper Bitcoin is manipulating the Bitcoin price. And he had this big long thread. I linked to it in the bullet point is linked to that thread. And so let me just read through this. This is a common trope from the gold bug space. I've heard this, I've been a gold bug, or I was a gold bug before a Bitcoin hodler for almost 15 years, going back into last century even. And this is a hugely common narrative in the gold bug space. Manipulation is everything. It stems from a misunderstanding of inflation and deflation, in my opinion. It goes like this. The Fed and the U.S. government printer go burr. So as an inflation hedge, gold should skyrocket, but it doesn't. Therefore, it is being held down by manipulation. It's the same thing we see creeping into Bitcoin right now. And Willy Woo is just one example. But manipulation and conspiracy is what's holding down the price, and not fundamentals, not supply and demand. I'm not saying there's zero effect from what he's saying here, but this is not the ultimate driving force. Okay. If they understood the way money printing actually works, they'd understand that gold has been an inflation hedge, but there just hasn't been all that much inflation. What? You say, haven't you seen M2? It would be more constructive to believe gold has been successfully, or would it be more constructive to believe gold has been successfully manipulated for decades by an omniscient cabal, or that maybe you don't know how money printing works? So you have to believe in this omniscient central planning cabal manipulation that has kept gold down for decades and is now keeping Bitcoin down, or the way more simple answer, you don't know how money works. And that was my hard truth that I had to come to. Before COVID, I came to that truth around, I would say, like 2018, as we were sliding back into, looked like recession, and there was no inflation from QE and all of this stuff. I was like, what is going on here? And so I had to ask hard questions. But a lot of gold bugs haven't done that. And Bitcoiners haven't done that either. But they will have to, because we're not going to get runaway inflation. Okay, back to Willy Woo. He said in this big thread he had, I can put in USD collateral and sell nearly unlimited Bitcoin futures contracts. Okay, but there always has to be another side, right? You can't just sell futures to yourself or whatever. No, you have to have, for every seller, there's a buyer. So you can't sell unlimited. Even if you have unlimited collateral in money printer go burr US dollars, you still can't sell unlimited futures contracts, because you have to have another side of that contract. And then he continues in a different section of this long thread. He has 5x leverage is the norm. So I would need 12 billion US dollars and absolutely no BTC in my futures account to stop Bitcoin price from moving upwards, even if all the BTC available on exchanges were being bought up. I don't believe that for a second. What he's saying is that physical futures settlement involves borrowing the underlying and selling it. So not the way it works in Bitcoin right now, but in physical futures. You have to actually physically borrow the Bitcoin or the gold, then you sell it in the hope that you can rebuy it lower later. That's what a short is. Okay. But if the price is higher, you must rebuy at the higher price and you have a loss. In a cash settled future, you don't have to borrow the underlying. You can simply open a short using USD as collateral. Willie's argument is that this effectively prints synthetic Bitcoin. Since you don't have to actually borrow it to sell it, you can just sell it by using USD. The way he's putting it here is this print synthetic Bitcoin. The spot price is controlled by this synthetic Bitcoin because of arbitrage. Keep printing synthetic Bitcoin and the arbitrage will keep the spot price down. It sounds very convincing, but it doesn't work like that. Willy Woo also claims losses to not be a concern for mega players holding the price down in this way. So if Bitcoin price goes up and they lose 50 billion, they don't care. That's what he's saying. But of course they care. I mean, 12 billion, you're already talking big numbers here. What entity cannot care about, and this is 5x, right? So let's say the price goes up 50%, they're going to be down. What would that be? 30 billion, something like that. What entity could lose 30 billion and not be concerned about it? That's what he makes it seem like. But I don't think that exists out there. You actually are losing money. So, and that affects everything else. You know, like the dollar is going up right now, and we'll cover the dollar here in a second. But the dollar is going higher. It's getting stronger. There's a dollar shortage on. Who doesn't care if they lose $30 billion? It's completely asinine to think that. The only way you would think that is if you think that the Fed and the government can print money at will, which they cannot. If they could, why would there be a dollar wrecking ball? The only semi-plausible explanation that I have heard is Tom Luongo's, where he's talking about there is a war going on between Davos and Wall Street. And Wall Street isn't printing dollars because they are trying to break Davos, break the global Marxists. You know, I can go down that path a certain amount, but I can't go all the way down that path. They do not print money. The Fed doesn't print money. The government doesn't print money. Only commercial banks print money. There's a dollar shortage going on. The dollar is getting stronger. Who doesn't care if they lose 30 billion suppressing Bitcoin? All those pieces don't fit together. All right, let's continue here. Also, if the overriding force is shorts controlling the price, you'd expect a persistent funding rate to be against them, meaning shorts have to pay to keep their position on. If you guys haven't traded, I'm not an expert trader or anything, but when you open up a futures contract like on Binance or BitMEX, there's this funding rate. And if the tendency or the weight of interest is bullish, the bulls are going to pay to keep that rate open. They're going to pay the shorts because the shorts need to get paid to actually show interest in taking the other side. Like I said, for every buyer, there's a seller. So if the overriding force is shorts that are controlling the price, you would expect a persistent funding to be coming from the shorts and paying the longs, but we don't see that. It's actually fairly close to even maybe a little bit more the longs paying. So it's not, and this is an aggregate of Binance and BitMEX. So you don't see this in the actual numbers here, that this is occurring as Willy Woo says. Okay, bottom line, I disagree with this. And my next Bitcoin Proton that's coming out, that's my premium newsletter or whatever that goes out to paid members, that is going to be all about this. I'm going to dig in really deep into this and try to figure out a good way to explain this. Anyway, okay. Ethereum has been Ethereum has been disappointing since Shanghai upgrade, according to JP Morgan. This week, I wrote about Ethereum in Proton 3. I don't often write about it, but there is exciting price movement, breaking below long-term support. And here you can see this chart here, this long-term support. It did break below 0.06 support. This red line is a little bit higher than that, but that's long-term support for the Ethereum Bitcoin price, and it did break down below that. So that's exciting. That's exciting for me because Ethereum is the king of all scams. And if Ethereum is going down, that's a good thing for Bitcoin. It's a good thing for the world if Ethereum crashes and burns, or at least maybe not crashes, because people will lose their life savings and stuff. But a slow bleed of Ethereum would be beautiful, because that would give people, time to get out and not just have the bottom fall out on them. So that would be the best of both worlds, just a slow bleed out. And that's actually what we're seeing since all of these upgrades that they did, these centralized upgrades that they did to their protocol. And JP Morgan is now saying that it's been disappointing. So hard times keep coming for Ethereum. Now longtime backer and reported big investor in Ethereum, JP Morgan, are calling it a disappointment. JP Morgan analysts led by Nicholas, long last name, expressed their concerns in a recent note. They pointed out that while Ethereum's energy consumption plummeted and the supply of Ethereum was shrinking, additionally, staking had risen significantly with a 50% increase since the Shanghai upgrade. Surprisingly, these positive developments did not translate into increased network activity. Whoa, amazing. Almost as if they're not positive developments. Gasp. Almost as if actual deflation is a bad thing and removes the inflationary stimulus that built the Ponzi of Ponzi's in the first place. If JP Morgan really is a big investor and backer of Ethereum, it goes to show how dumb it is to believe that in all these elite conspiracies. So JP Morgan, big bad top of the cabal, Jamie Dimon, his outfit, I mean, he's not part of this report or anything, but it's his outfit. And he's calling all of these things are obviously not positive developments. How can people believe in these elite conspiracies with that kind of result from JP Morgan? It doesn't make sense. Okay, moving on to macro headlines. The macro landscape right now is one of collective holding our breath. The dollar continues to creep higher, DXY at 106 this morning. Oil seems to be defying gravity as well, hitting a high of 92 on the 19th. And most surprising to me is the U.S. 10-year yield going higher, passing 4.52%. All these trends will reverse rapidly. I have explanations for all of them. The dollar is being squeezed by international recession, forcing them to sell treasuries, and the U.S. buying oil to refill the SPR ahead of the 2024 election season, when they will dump it. So I'm probably going to be writing about all that stuff on the BM Pro. So I've linked to where you guys can subscribe to that. Okay, next headline, FOMC nothing burger. The FOMC met last week and paused rate cuts again, or rate hikes. Damn, my typo there. Rate hikes. They paused at the June meeting and then raised at the July meeting, and then they paused this meeting. The dot plot and the Fed funds futures are very similar. And I pointed that out last week when I talked about it. At most, predicting one more rate hike this year and then turning to rate cuts next year. Both the dot plot and the Fed funds futures are very, very close. The Fed funds futures does not show an imminent hike by the end of the year. It actually trends a little bit higher than here, but not up to the next level of a rate hike, where the dot plot does. So they are a little bit in disagreement here to the end of the year, but in 2024, they're very much in agreement with showing a couple rate cuts next year, starting around the middle of next year. Okay, Fed funds futures are pricing in a 78% chance of a continued pause at the next meeting, and that will be November 1st when that comes out. No move is more likely than a pause until probabilities switch to a cut in July of 2024. So that's weird wording there, but basically a pause is the most likely scenario until July, when the most likely scenario becomes a cut. And I think that's even different than middle of last week when it was June. Now it's been pushed out to July. It keeps moving later. The cuts that the market sees keep moving later. What does that tell you? That tells you that the economy is doing okay. And, my conclusion from all my last week's content was that Bitcoin has plenty of room to rally into the halving and even after the halving. So if the halving is early April, July is when there's probably going to be the first sympathetic cut from Powell. So Powell's MO, and that's what I write about here in the next paragraph, is that he did cut 3 times sympathetically before the repo rumble in 2019. So he actually saw the recession. He started cutting, which he initially termed a mid-cycle adjustment, but he started cutting, and then the repo rumble happened. He had to cut more. And then, of course, March of 2020 happened, and they went all the way to zero. So he did see it coming, and he did sympathetically cut, and I think that will be the case as well in 2024. But what does that mean? That means the economy is not falling off a cliff yet. There's a big difference between a recession and a financial crisis. I think that's what a lot of people don't quite grasp. We have been in a 15-year recession. Just because the GDP and the official MBER agency for the United States government, whatever, doesn't say we're in a recession. We're in this silent depression, a very long-term period of low growth and low inflation. What is going to kick off official recessions are going to be financial crises. And we didn't have financial crises like these back in previous generations. We didn't have periods where the U.S. Treasury market went bidless and the Fed had to step in, slash rates to zero, and be the lender of last resort like this. These are new. And these financial crises are becoming, that's the way we go into recession. I mean, official recession. So we're going to have post GFC normal, which is the silent depression. That's what I've been saying for a long time. Hold on a second. Someone's calling me during my live stream. We're going to go back to low growth, low inflation, which is going to feel like a depression. It's a silent depression. That's what we're going back to. But the actual official recession and what we want to time are these like kind of financial crises singularities that happen. And the market's not saying that's going to happen pretty much at all next year. Maybe towards the end of next year, maybe end of Q3 next year. Holy cow, would that be bad for the incumbent administration in the United States going into election season? So very interesting what's going on here with that. Let's go on to the next story. Federal Reserve's reverse repo facility is crashing. And you can see this chart here, really selling off here, down to about 1.5 trillion. It peaked back at the beginning of the year up at about 2.5 trillion. And it has since sold off. But I mean, the way this works is these are overnight loans. So these institutions go every day pretty much and will roll over this repo that they have with the Federal Reserve. Now, there are some that are 7 days and I think 14 days and even some that go out to 30 days. But the majority of them are overnight. And so this is a constant thing. But what we're seeing here is fewer and fewer people are coming to the Fed with their dollars to get collateral. And let's read what I write here. So I said, this is something that has flown under the radar, being overshadowed by the Fed's balance sheet and the government debt, hitting 32 trillion or whatever it is. The reverse repo facility represents the collateral shortage versus a money shortage in the economy. When there is ample money deposits and not ample collateral to move that money around, remember, money flows with collateral lubricant. The mismatch forces dollars into the reverse repo with the Fed. The Fed takes the money and lends its collateral from its balance sheet of government securities out to the banks. So, they did all this QE. They have all these securities on their balance sheet, which they're doing quantitative tightening as well. So they're kind of letting those roll off. But they would take those and swap them with dollars with banks because banks would need more collateral liquidity. They had plenty of deposit liquidity. They need more collateral liquidity, at least these big players that are doing this with the Fed. But what we're seeing here now is that liquidity is flip-flopping. And we see this in the dollar as well. Liquidity comes from two sources in the modern system, collateral and cash. You must have both. When there is liquidity in cash but not in collateral, banks would normally be able to go to the private Eurodollar financial system and do this kind of reverse repo. But when the system breaks down, as it is right now, and nobody trusts each other, There's contagion out there. There's stigma attached to this. Nobody wants to repo with people, even for safe and liquid assets like off-the-run treasuries or something. The Fed becomes the lender of last resort. The dropping of this balance could mean that collateral is becoming more liquid in the financial system, or that the liquidity premium enjoyed by cash is going away and cash is becoming more tight, which that's what I think is the answer here. Cash is becoming more tight. The dollar shortage, it's switching from a collateral shortage into a dollar shortage, and that's what we're seeing going on right now. Okay, let's talk about the Treasury buyback plan. I did cover this on Friday's live stream, so I won't cover this too much. I think that it is an interesting proposal here. They are going to be buying off-the-run securities, which are just kind of stagnant, older government security, government bonds. And they're going to be rolling them over basically to short-term, more liquid stuff. So they're going to provide a bid under the market so that they can never go bidless like they do in these financial crises. So that's their plan, at least. So the inflationary impact of this policy is unclear, but I tend to believe the effect of stigma is always underestimated. For example, if the Treasury is forced to do this kind of program, they're signaling the economy is in dire straits. Why would they have to do this if the economy were healthy? Same with QE. QE signals an unhealthy economy. It's actually counterproductive to what the authorities, the omniscient central bankers that people think they are, it's a catch-22. They can't do QE because and get out of the silent depression because it's signaling a bad economy on its face. Stand by. My boys needs my attention real quick. All right, and I'm back. Okay, where were we? Wrapping up this. Bottom line, if the economy was functioning well, we wouldn't need these type of programs. Okay, let's go on to the Bitcoin price. So like I said, the price has returned to the extremely boring 26K area. Did have a little green candle here, which was nice for the day. Let's take a look at the live chart, actually. This green candle is coming in nice and strong here to finish the trading day, 26,400. Let's go down to the hourly, see what we got here. Okay, we're pushing back up, 26,400. Let's see if we can break this zone. I mean, look how boring this price was right here for the last few days. It just stuck at 26,600, then fell. Now it's coming back. I mean, this price is not super exciting, but we will see. We will see how this goes. Let's go back to the report. But it has shown some strength relative to the S&P 500. So the S&P 500 is actually down 4% since this recent swing high, and Bitcoin is only down 3%, which is good. Usually Bitcoin would be down 10% if the S&P was down 4%, right? But we are only down 3%. We're down less than the S&P 500. Overall, if we go back to post-GFC normal of low growth and low inflation, that's good for risk assets. It's also good for bonds. But yeah, okay, so that is that. What else did I say here? I drew those arrows. Okay, the dollar is also breaking out right now to new yearly highs. To carry on the discussion from above in the macro headline section, the collateral shortage is transitioning into a cash shortage. So let's bring this up. You can see yearly highs here today, just breaking through. Also, I did post let's go back to the chart and let's go to the broad dollar. And it only does the daily. But you see the broad dollar here on the daily has been coming down. It topped around the 7th of September, and it is already starting to come down. Now, the difference between the broad dollar and the DXY is the DXY is heavily weighted towards the euro, then the yen, and then the pound, where the broad dollar is trade weighted. So there is the Chinese yuan in there. There's also the Mexican peso. Those are important currencies that are included in the broad dollar and not in the DXY. But you can see that it topped, almost 2 weeks ago and has been coming down, where the DXY here is continuing to rally higher. So the weakness is against the major economies. It's against the euro for sure in this DXY. That's what's coming through here. Again, signaling a dollar shortage from Europe, really centering around Europe. Okay, let's go back to the report. I also pointed out last week on BM Pro that at the start of bull markets, the correlation coefficient for DXY and Bitcoin tends to switch positive. That means they both rise together at the beginning of the bull run. It was only during the COVID era that this relationship broke down a bit. And let's take a look at this. So this is the correlation coefficient between the DXY and Bitcoin. And you can see back here in late 2015, the correlation coefficient was very positive, about 90 or 0.9. And that was at the beginning of the bull market. Then we went indirect correlation. Then it came back up. This is the highest in record between the US dollar and Bitcoin. And that was right at the end of 2016. Again, right as that bull market was heating up. And that was, I think, 0.93 on the correlation coefficient. Then beginning of 2019, the beginning of that bull market, correlation coefficient went positive, pretty high up, probably about 0.8. Right before COVID, but COVID is kind of one of these singularities that's hard to analyze. But right before COVID, when it looked like we could be breaking out here again at the end of 2019, the correlation coefficient was also positive. And then most recently here at the end of 2022 into 2023, when we bottomed after FTX, correlation coefficient spiked up again to 0.8 roughly. And we'll see. Right now, we aren't seeing this correlation coefficient turn positive. But what I'm trying to point out by this chart is that I'm trying to show that if the dollar strengthens, that doesn't mean Bitcoin must fall. In fact, at the beginning of bull markets, they are positively correlated. All right, so then I finish this up. I still believe the likelihood of a significant green weekly candle is higher than normal, but I do not expect us to break right through 31,000. Downside risk is low, in my opinion, so I'll be aggressively buying any dips. Okay, let's get into mining headlines. Bitmain to invest $54 million in Core Scientific as part of new supply contract. So Core Scientific has had a rough go of it the last year with their bankruptcy and back and forth court battles and stuff. However, the last 2 weeks, we've seen headlines that are positive for them. Last week, they finalized a deal with Celsius Mining for a Texas facility. And this week, they penned a deal with Bitmain for 27,000 miners. And this is quoting from the press release. Bitmain and Core Scientific have agreed on a combination of equity and cash to finance the purchase of new and more efficient Bitcoin mining equipment. Separately, Bitmain has executed a new hosting agreement with Core Scientific to support Bitmain's mining business. So I think this is positive for them. We'll have to see how this turns out. And again, Texas. This is a Texas, their facility. I don't know if they're going to have other facilities, but that one that they talked about last week was in Texas. Bitcoin mining can help reduce up to 8% of global emissions, report. This is a quote from the report. A paper published by this is a quote from the article writing about the report, which I linked to in the bullet point here. A paper published by the Institute of Risk Management, IRM, concluded that Bitcoin has the potential to be a catalyst for a global energy transition. I don't like that terminology because it hides in here this transition to renewables when that's not the main thing here. I mean, if Bitcoin helps, I guess that would be a positive. I don't think it would be a negative. I don't really see it as positive or negative. It's just what it is. But I don't like that word. It's too globalist for me. But anyway, according to the report, Bitcoin mining can reduce global emissions by up to 8% by 2030. This can be done by converting the world's wasted methane emissions into less harmful emissions. Now, there you go. Okay, this is what I like. This is not a transition. This is just smart business. Wasted methane emissions into less harmful emissions. Is that transition? No, that's not renewable. I mean, I guess it kind of is. I don't know exactly what you would call that, but it's not solar and wind. It's methane from landfills and stuff. The report cited a theoretical case saying that using captured methane to power Bitcoin mining operations can reduce the amount of methane vented into the atmosphere. So anyway, that's some of the stuff. And we just continue having more and more of these positive headlines coming out about Bitcoin mining. And obviously it has to do with BlackRock wanting to turn Bitcoin's image, maybe like British Hodl was saying, maybe make it into an ESG play, like Bitcoin actually becomes an ESG investment. But I don't know about that. But BlackRock is obviously trying to clean up Bitcoin's image here, and we're noticing a lot of these positive headlines because of that. So anyway, very, very interesting. Okay, difficulty and hash rate. And I did not update this paragraph. Oh, man. So anyway, let me just pull up this chart. Last week, we did adjust up 5.48%. So that is a pretty nice jump to an all-time high difficulty. And I also included a hash rate chart here. And the hash rate did hit an all-time high as well. Look at that, just surging over the last week. It is down a little bit over the last day or two, but Bitcoin hash rate, Bitcoin mining is very, very competitive right now and continues to expand despite the price being so boring and like kind of threatening to dip here. I don't think the price is going to dip, but it's threatening to dip, yet the hash rate is surging. So that should be a confirmation that this price level is very healthy and it doesn't, there is no big dip coming. Okay, mempool. So mempool has drastically shrunk in the last 12 hours. It's hard to see on the yearly chart, but I do put a weekly chart here. It's down from 225 megabytes to 175 megabytes this week. And like I said, on this yearly chart, it's hard to see the last day over here. It comes down drastically. Look at these colors. So specifically, look at these the yellow and greens into the blues. And now let's look at the weekly chart. This is 1 week of the mempool. You can see the yellows and the greens go away, and it's starting to chew now into the blues. So these are fee blocks, the pink at the bottom, 1 Satoshi per byte. The yellow, I don't know what it goes up to. I think it was like 30 Satoshis per byte or something like that. And all of these are different levels. And as it chews through, that means it's going to cheaper and cheaper transactions down here. And we will see. I think there was something with ordinals. There was some inscription bug, and that might have stopped them, turned off the inscribers, whatever is doing the inscriptions. And so it has chewed through there because they turned that off. That could be a possibility. I don't know much about that. But okay, guys, that's it for this week. Thanks for joining me. Ansel Lindner, Bitcoin and Markets. Check out bitcoinandmarkets.com. Make sure you signed up for BM Pro. And that's going to do it. I'll see you on the next one. Bye. Oh, I have my mic muted. What's up, guys? Any questions, comments, concerns? Hope you're doing well. Surviving this boring time of price. Hopefully we'll get some green candle action here. I don't know. I don't know how much more I have to say about that. I don't think it's happening. I mean, I do think it's happening, but I don't think it's an overriding thing in the market, okay? Every buy and sell moves the price. It manipulates the price, quote unquote, manipulates the price. And the big whales can do that too, but the big whales are fighting each other as well. There's always a whale fight going on. And if there's some big entity that's willing to lose 50, $100 billion on naked shorting Bitcoin on leverage, some whale is going to come in there and fight that whale, take them to task. So it can happen over a short period, but it cannot happen long term. I don't know. What do you guys think about that? All right. Well, no hands. I'm going to bounce out. My daughters have softball practice, and I just saw that there's inclement weather. So now they're going to another field. I'm driving their other friend, so we have to pick them up. And then my other daughter, she does fencing. So she has that tonight. So, and like with the internet that went down, my wife like didn't work for the first part of the day. So she went into the office, and then she's having to stay late to take care of her work. And it's just when you got 4 kids, it's a mess. But anyway, all right, guys. Thanks for joining me, and I'll see you on the next one. Peace.